All right, hello everyone. Thanks for your patience today. I want to welcome you to the NinjaTrader Ecosystem webinar room. Before we do get too much farther into this presentation, I want to do a quick test of picture and sound. So if you can clearly hear my voice and see the projection in the room, do me a favor and type in the city you're joining us from. All right, already getting some confirmations. Appreciate the quick responses. And thanks everyone for joining us. My name is Jared Meyer, and I work on the NinjaTrader business development team here at our Denver office. Excuse me. We have a very special event for you today with Daniel Roe and Josh Benton of TradeThePlan. While everyone's getting settled in and ready, please take a look at this instant poll for us here. Choose 1, 2, or 3, and it'll give us a gauge of what type of NinjaTrader users we have in here in attendance. And while everyone is taking some time to fill that out, I do want to remind everyone that it is important to understand that there are substantial risks in trading commodities, futures contracts, and Forex. You should carefully consider whether such trading is suitable for you, and that will depend on your specific circumstances and financial resources. It is possible to lose all the funds deposited with your broker, could even incur losses beyond these amounts. Please inquire at this web link I'm going to provide here for you shortly for more information, for a copy of the CFTC full risk disclosure. Also, please do remember these training webinars are not a solicitation or recommendation, but simply educational in nature. All right. I just want to give everyone a heads up, too, that this presentation is presented by NinjaTrader LLC, which is the technology company responsible for developing and supporting the NinjaTrader trading software. Brokerage-related questions should be directed to NinjaTrader Brokerage directly at 312-262 by emailing brokerage.sales@ninjatrader.com. And I'll put that information in here as well. There's a phone number, and here's the email address as well. All right. Oops. All right, so quickly I want to go over the poll. I want to thank everyone for filling that out. It looks like a majority of folks in the room are not lifetime license holders, over 65% of you. Thank you so much for joining us today. I hope that you all enjoy this presentation from Daniel and Josh. We have another about 10% of you that are using a free key, a few of you that are leasing a key, and about 10% of you that are not yet using NinjaTrader. Just to give everyone a quick heads up, NinjaTrader is free for advanced charting, market analytics, and automated strategy development. Connecting to a live data provider and simulated trading. We do only charge for our product if and when you decide to trade live through any of our supported brokers. If you haven't done so already, I invite you to download NinjaTrader for free from the following link, or you can purchase or lease it from the link below as well. So I'll throw that in there right now. Oops. All right, so I'm going to close up the poll. Thank you again for your participation there. We are very excited for this unique event in which Daniel Roe and Josh Benton of TradeThePlan reveal how the VolumeAnalyst tool helps traders forecast major trends in any market. Thank you again for your attendance today. Without further ado, it is my pleasure to welcome to the NinjaTrader webinar room Daniel Roe. Please take it away, Daniel.
All right, perfect. Thank you, Jared, and thanks for putting up with me. Yeah, we've had some technical difficulties here, but I think we've finally got it sorted out. So just a big thank you to Jared and to everyone else at NinjaTrader for sponsoring the event. It's a huge honor and a privilege working with you guys, and working with Ninja 8 is really incredible. It's a huge step up, and the things that we can do now in Ninja 8 are pretty amazing. You know, they kind of opened up the platform for programmers so that we can create some pretty advanced tools, and we've done just that. So thanks to you guys. Jerry, I'm still not seeing the notes. I don't know. why that's the case. All I
Let me
see.
go back to your other slide.
Okay, it kind of popped up for a second and then it went back down. How bizarre. Just bear with me for a second, guys. I'm going to kind of pop through this. There they are. Okay. Finally. Perfect. Okay, thanks. All right, well, let me just kind of talk to you guys for a second. I imagine everybody hears me fine and you see the screen well. Let's just kind of, let me address you guys a little bit. So I'm sure some of you have had some success, in trading. You probably had a taste of what it's like to actually make money from trading, and maybe now you're hungry for more. Maybe you're looking for, I don't know, a new tool or method, something that kind of helps take the guesswork out of your trading. Basically, you want a real edge. Well, that's what I'm going to share with you today. Maybe you're new to trading, or perhaps you've only been trading for a short time. If that's the case, then basically you want to find the right methodology to invest in, right? To invest your time and money in. If that describes you, you should get a lot out of today's training as well. My goal is to help you save time, money, and hopefully some heartache by simply teaching you about what works and what really doesn't and can't work. So then there are many of you here that are still struggling. I would say probably the majority. Maybe your current plan just really isn't producing the consistent results that you've wanted. You're simply in a rut. You probably have lots of doubts and fears when it comes to your current trading methodology and strategy. Well, I'm here today to help ease your doubts and fears. I too was in a rut not too long ago, and I've been in several before that, so I know exactly how it feels. So I'm here to present a solution that can really help you get out of that rut, where doubt and fear is replaced by confidence. So why do most trading courses and software simply not produce the kinds of returns that most people are promised? Most people, the people selling them tend to promise. Well, I've been in this trading industry for over a decade now, I guess 11 years. I've researched many of these trading systems that are available. I've bought dozens, quite literally dozens, with their slick marketing. They promise the world. Well, here's what usually happens. Step one, you're armed with exaggerations and lies. You're told you'll be making X amount of dollars per day in no time. So you fork over thousands of dollars for some state-of-the-art trading system. The second you get it, you're super excited until you start. And what's step two? Well, yeah, what is it now? What? It's just supposed to magically happen for you, right? They say to just follow their rules, and no way you fail at this. And the next thing you know, it's basically you're sipping martinis from your yacht as you trade from Bora Bora or something. The truth is, it doesn't work that way, obviously, for anyone, no exceptions. It can't work that way, and yet, for some reason, I was guilty of it too. We just kind of succumbed to that marketing, but because we want to believe it. Well, this is the toughest business in the world. I'm sure most of you know and appreciate that. It's certainly no get-rich-quick scheme, despite what many would have you believe. I hope most of you know that, but it needs to be said. So there will be no false claims here. Instead of hyping some dream lifestyle, I just want to give you the facts. I'm going to be going into quite a bit of detail, which is something I guess I'm OCD or something, but my attention to detail is so enormous that, well, let me put it this way. I hope I don't lose you. There's a lot of information in this webinar, and I know it can be overwhelming for many. It's just kind of usually the case when I'm teaching, but by the end of it, if you follow along and you're able to kind of keep up, and I'll go as slow as I can, you should have a better understanding about what actually works and what doesn't. And you should be able to take, at least some of what I share here today and put it into immediate practice with your own trading, with or without my tools. So I want this to be more educational than anything today. I don't typically enjoy trying to market. I want to be educational. I want you guys to learn something and be able to take something away from this. But that reminds me, there's really just way too much to cover here today in only 1 hour. Well, really 45 or 55 minutes. So I've decided to break this up into 2 parts. Okay, today the training is sponsored by NinjaTrader, which will be more for educational purposes, so that all of you, like I said, can take something away without having to spend any money. But being that there is so much information to go into, we're going to do a part 2 on Saturday. Okay, it's going to be the same time, I guess 15 minutes earlier. It's going to be at 4 p.m. Eastern Time, December 2nd. And let me just post this link to sign up for that just before I forget. So that'll be Saturday. And today is all about education, going over the tools, kind of building up to the full demo and going into all the details and all the features of the software on Saturday. Okay. So, like I said, it's a ton of information to try to get through in one setting. And the tool, this is really a massive piece of software. It's basically, well, now I guess it's about 8 different tools in one. So it's a huge amount of programming. And I want you guys to, to get a lot out of this. So we'll go over all those details on Saturday. So that event will not be sponsored by Ninja. I'll be doing it myself with my team using a different platform, different webinar platform. So we'll send out another email about that. We did send one about that yesterday and today. And I guess you guys can see that in the chat. Do you see the link? If not, we'll go over it again here at the end. So moving on, if I can move on. There we go. So what's the secret to successful trading? Well, everyone wants to know that secret that separates those who succeed from those, well, basically from everyone else. Well, it's really pretty simple. It's all about your mentality. I've seen it hundreds of times in all walks of life. That's not to say there aren't, real, tools and understanding and things that you have to implement, but it starts with the mind. So the mentality for success really just originates in that climb out of the hole. Yeah, I'm messing this up here, but anyway. Okay. So most people spend their time hoping and guessing, but never really find their way out of the hole. Well, that's kind of where I shine, I guess. You see, I'm not really a slick marketer. Like I said, I'm not even a great presenter, obviously. But I do have the tools, the system that really help people climb out of that hole. Most of my clientele have been through the ringer a few times. I've talked to, several dozen of them that have fairly similar stories to mine. In fact, they kind of see me as their last ditch effort, as they, came across me after they've already been doing this for X number of days, or sorry, X number of years, or thousands of dollars in systems. But at any rate, I believe in these guys. I believe in these survivors and my clients. I believe the mentality for success that they exhibit really originates in that, that having to climb out of that hole. Failure breeds humility, and humility is needed really for anyone's ego to survive, the inevitable consecutive failures that we have to endure in trading. It's almost a kind of rite of passage or something, I think, really, to blow an account or two before you actually make it to, consistently making money, consistent profitability. But anyway, every successful trader that I've ever heard in interviews it all goes the same way. They've blown up at least one account, some of them 5, 6, 7 accounts before they finally got the hang of it, basically before they started to really understand what it takes to make money consistently. So people who win, they start by winning slow. Overnight successes are destined to become overnight failures, obviously. Think about poker. It's the discipline players, right, who understand the mechanics behind the game and who make informed decisions based on patterns, probabilities, and expectancy. So in all my years, I've learned one undeniable truth. Those traders who succeed are the ones who understand how to develop a winning edge. So what is an edge? I'll get into that in a minute, but you have to understand probabilities and you have to be able to define that, right? You have to be able to define that edge. You don't simply, just use that once or twice. It kind of becomes your foundation, your advantage over the dealer. Those who succeed are also disciplined in using that edge over a long period of time to achieve more earnings than losses over time. So I mean, ask yourself, do you guys have that edge? I would say most of you probably don't. I can remember, when I was doing all of this, going through webinars and buying all this different software, I thought that what I was working with had the potential to make money. I thought it was good. I thought it was an edge, but I didn't make money with it. It only, happened later that I was able to prove it out beyond a shadow of a doubt that no, it didn't have any edge. It didn't have any chance of making money over time. It was a joke. But anyway, so I put this here. This is not something I typically do. I don't like to talk about myself or toot my own horn or whatever, but we get a lot of good feedback. I mean, you can see these testimonials on futures.io, Big Mike trading forum, Google Maps, Facebook. And these are just a few guys in our room. Two of them, Bobby and Tim, have actually become pretty good friends of mine. Bob, I mean, I've known Bob for a while. We don't talk as much, but I've talked to him several times. I'm very familiar with Bob. But anyway, we all kind of help each other in our trading room, right? And it's kind of an open forum. Guys can come on and talk throughout the day, throughout the morning, whatever. Anyway, Bobby kind of started off like most people, kind of that, a fan of red light, green light stuff. Who doesn't want a system that is red light, green light? You just pull the trigger and make money, right? All you got to do is flip a switch and you're making money. Well, obviously he lost a bunch of money like that, not to mention time, and was deep in the hole and wanted a way out. Here's what he said. So after giving away close to 10 grand, I was still searching for a more common sense approach to trading. I found the logical answer in market geometry and volume analysis. So market geometry is another form of analysis that we use in conjunction with the volume. After a couple of conversations with Dan Rowe, I was sure he was the man I wanted to learn from. Dan's approach to trading has a great track record since the 1920s. I think he just means, market geometry and volume in general. I'm proud to be a part of the TTP family and look forward to trading in the trade room every day. And Robert says he had a ton of experience in day trading. Unfortunately, he learned several bad Me Too systems that produced lackluster results. He too was in the hole and looking for sunlight. He found my system and said this: my trading and understanding of the markets has significantly improved, but I had to unlearn all the bad ways I originally learned to trade before I could become a better trader using Dan's methods. Dan utilizes a low-risk, high-reward, multi-time frame methodology. His software is state-of-the-art, employing market geometry and volume analysis. Tim, I'm not going to go into too much detail, but Tim mentioned one thing that kind of drives me crazy. There's a lot of people, well, I understand why, but there's a lot of people that say that volume analysis is useless and that it can't work and doesn't work, so you need to ditch it. And that's evidently what he was taught before finding me and starting to work with us. So I understand why people think that, because they don't know how to look at the data. everything in trading is about data. Do you have good data, or are you manipulating it and transforming it into something that's useless? Most people do that with their awesome Renko bars and whatnot. But anyway, so a little bit about me. I'm going to try to get through this stuff fast, guys. I know it's getting overkill here. I'm just going to run through this. Basically, I started in 2007 working for a private equity fund in Ecuador. My boss paid for my education. They were actually using market geometry and volume, and they were doing pretty well, but he wanted to do better. And since we kind of went to school together in Paris, and I was good friends with he and his wife, he hired me to work at his family's fund, and then thought that, basically I would be able to put together something. I guess he had a lot of faith in me, thought I was pretty smart, and we had kind of grown up in this whole technological boom, so he thought that I would be able to research this and put together something that would make even more money, right? Because I would be able to figure all this automated trading stuff out. Well, turns out, no, that's not what happened at all. Basically, we spent tens of thousands of dollars on systems and training, education, all this stuff. And when I went live, after a little bit of success in Sim, I proceeded to blow a pretty big account over the whole 2008 bust, 2009, basically when everybody was losing money, everybody that didn't know how to trade in a bear market anyway. So, yeah, needless to say, last in, first out. So by 2009, I'd moved back home, continued buying all sorts of courses and systems and whatever, borrowed money from family even, and started trading live with that and blew that account. So that's 2 accounts now. Then my 2010, my father passed away, and I spent even more money on education and systems, another trading account, and blew that one also over the next few years. So finally, 2013, what's my problem here? Why do I keep doing this stuff? Something's wrong with me? Am I an idiot, or what's the problem? Well, I didn't have an edge that I could prove out. There was no way for me to really prove beyond the shadow of a doubt that what I was using had the potential to make money. I thought it did. People told me that it did. The people I bought it from, of course, right? So 2013, I was looking in to try, I want to be able to program. I want to be able to test this stuff out. And am I going to spend the next 5 years learning how to become a programmer, or is there an easier way? I found this product called Bloodhound from Shark Indicators, and it's basically a drag and drop visual programming kind of a interface deal. And you can build out some pretty incredible rule sets that you can then backtest. So it's not, it's not like Excel and kind of basic quantitative, if the market goes up for 3 days, what happens over the next 2 days on average. It's much more in depth. You can do pretty advanced programming with it. So I picked that up and ran, and then by the end of 2013, I was actually offering a service to kind of make Bloodhound templates and strategies for people. So that took off. I think I worked with well over 300 people over the next 2.5, 3 years. And through that, I was, not only working with five or six people a day, typically, a lot of the same people over and over, but we could crank out a full-blown strategy in an hour if they had exactly the rule sets that they wanted to build out. Very fast and easy to do that in Bloodhound. So I became very proficient with that, not only building and testing all the systems for other people, but for myself with all the different things that I had acquired over the years. And turns out that about 95% of what all of us think works and is useful and is good and can make money over time, it's not true. Excuse me. So kind of sad but true, and you don't really know that until you can actually test it and prove it out. And, I can sit here and tell somebody that what they're using and what they're doing doesn't work and it can't work. And it can make somebody so mad that they won't ever talk to me again because I tell them that, stop wasting your time. What you're doing doesn't work. It can't work. People put a lot of kind of emotional, I don't know, they attach a lot of emotional baggage, I guess, to these really expensive trading systems that they've been working with and spent all this money on. It's pretty hard to give some of that stuff up, isn't it? Well, anyway, through all of that, I put together some things that I could prove that I knew did work, that I could prove out, and put that together. It's basically a few different things. It's not very many, but of course it's not quantity. It's quality over quantity, right? Anyway, with what I'm doing now, well, I'm not going to get into results. I'm not going to show any results. It's not the point of this webinar. But anyway, I finally proved some things out that did work. And, it's like nobody wants to take this Edison approach, right? It's what did he say? It's not 1,000 failures, but 1,000 steps on his way to inventing the light bulb. Well, what I'm doing is not, it's not as sexy as inventing the light bulb, but I think it is pretty incredible. And once you see how we have sorted out the problems with volume, I think you'll agree that it's pretty powerful stuff. Anyway, I started trading in a sim account again to prove it out very strictly. And anyway, I'm not going to get into all the results. I started trading live the beginning of this year, the end of 2016, and it's pretty incredible. So a lot of people think the markets are completely random. If you think that, then there's no reason for you to be trading. If you think the price action is completely random, it makes no sense for you to be trying to make money trading the markets. When I went to school, I was force-fed this stuff. Markets are completely random. You have the efficient markets hypothesis. You have all these models and stuff for pricing things out and whatnot. And that's what the academics will tell you. They'll tell you that the markets are completely random. If this is true, then you can't make money, so you may as well give it up. But we all know that there are tons of people. There's some very famous people that make their living, a huge living, trading the markets. So they're certainly not random. Now, there are some aspects of the market that do kind of seem random. They're a little bit chaotic, but just because they're chaotic doesn't mean that they cannot be somewhat predictable, right? Just like with the weather, you may not be able to forecast what's going to happen next month or next year, but you can have some success in the short term, right? Weather's a chaotic system. The markets are arguably chaotic, but there's a lot of really advanced papers on this stuff, academic papers, even recently. And the markets are more kind of very low complexity chaotic systems. So at any rate, let me just kind of read to you what this is all about. So what is a chaotic market? It's a complex system that shows sensitivity to initial conditions, such as an economy, a stock market, or weather. In such systems, any uncertainty, no matter how small, in the beginning will produce rapidly escalating and compounding errors in the prediction of the system's future behavior. To make an accurate prediction of long-term behavior of such systems, the initial conditions must be known in their entirety and to have an infinite level of accuracy. So basically, you have to know the initial conditions in their entirety to have any level of accuracy. So according to these guys, it's impossible. All right, but what about the short term? Well, obviously we all joke about meteorologists getting the weather wrong, but you know, it may not be right. They may not be right 100% of the time, but they're usually pretty close. So the markets are somewhat similar to the weather in this respect, but with the markets, like I was saying, it's a low level of complexity because we know what some of those initial conditions are. We may not understand all the ins and outs of them, but basically those initial conditions are people's decisions. Their decisions to buy or sell. So what causes price to move? It's one thing. It's a transaction. It's not a million different things. There's a million different things that may go into, you know, why a person would buy or sell something. But the act of what causes price to move up and down is the actual changing hands of the volume. So it's the volume that creates the price, you understand. It's the volume is the most important information. All right, so let me just get through this stuff because this is taking way too long here. So supply and demand, a lot of us tend to boil it down to supply and demand, but it's really, you know, it's more about people and their decisions. So some people make really dumb decisions, some people make smart decisions, but what do? They tend to move en masse. They tend to move in herds. And when they move in herds, their behavior becomes more predictable. Okay? So this is just me trying to prove to you that yeah, the markets appear chaotic and they do seem rather random, especially during news announcements. But I assure you, you can predict the movements of markets with some degree of accuracy. And you don't have to be right even 50% of the time to make money, especially if your reward to risk is properly sized, if your reward is much larger than your risk. All right, let me just go on here. I'm spending way too much time on this. So talking about defining an edge. Well, what is an edge? An edge is just one thing happening, you knowing one thing happening over another. The probability of one thing happening over another. Basically, knowing something that isn't random about the market. All right, just basically one occurrence in the market where we have better than 50-50 odds to consistently move higher or lower within the relatively immediate future. So in the very short term. Right? Then using that probability to generate more earnings from your winning trades than losses from your losing trades. That's you know, that's what an edge is. Okay, so let's just take one example here. Imagine, just to kind of put it into perspective, you have 100 trades. You group those into two sections. You group them into money that you made from those trades and money that you lost from those trades. If by the end of those 100 trades, and it needs to be much more, but at least 100, if by the end of those 100 trades, your pile of money from winning trades is higher than your pile of money from losing trades, well then you have discovered an edge, preferably with something more like 500 or 1,000 trades. But if you've got 5,000 from 40 trades in your winners and you've got 4,200 from 60 trades in your losers, well, you've got an edge. You've just made $800, right? Well, you see the deal here? That's only 40% winners, right? But my winners were 125 bucks each and my losers were 70. So what is that? That's, I think it's like 1.8 to 1. So it's almost 2 to 1 reward to risk. So if you can consistently do that, make twice what you lose over time on average. Well, this isn't even on average. This is just for the winners. Anyway, you don't have to be right even 40% of the time, and you can still make a nice profit. This is an equation right here that all of you should memorize. You know, there's a lot of people that will show you how to kind of get started trading and just go for a really small winner, right? But to do that, you've got to use a larger stop. I'm sorry, but that's trading with your reward to risk upside down. You want your targets to be consistently larger than your stops. Okay, and this is a quick and easy little equation. You can stick your stop loss, your target in there, and it will spit you out a percentage that you have to meet in winning trades just to break even. So we do that here, and it's 35.9% of the time we would have to be right just to break even, not counting commissions. So if you're right 40%, that's only, I think, 4% more of the time, you're actually making pretty good money. So to make money from the markets, we don't have to be right, 50, 60, 70% of the time. We just have to be right 40% of the time if we're making more money consistently than we're losing. So the edge doesn't have to be, real glamorous and, this huge kind of probability in your favor. It can be a slight edge. What is the edge in blackjack? I think it's 49.51 or something like that. It's like a 2% edge if you're counting cards and all that. So something to think about, something to know about, and you need to understand this to really get through what probably a lot of you are dealing with, not really knowing whether what you're working with even really has the potential to make money. For one thing, most of us can't follow our plan long enough to actually test it thoroughly because of our lack of discipline, especially when it comes to holding losing trades or moving stops or stuff like that. So most of the time we just think, well, we're just, it's our fault. It's not the system's fault. It's our fault. We're just not executing it properly. But 9 times out of 10, the system that you're actually trading, it doesn't even have the potential to make money. I see a lot of people with stuff like this when I was doing those trading systems. I don't know why this is not showing up correctly, but I only see half the chart. Anyway, is this what an edge looks like with all these indicators? What do you guys think? I'm sure some of you are still doing stuff like this, right? I'm not going to go into all the details of this, but let me just talk about something, maybe it's a little bit advanced, but it's called multicollinearity. Multicollinearity. It's a well-known term in the field of statistics. All right, I'm going to have to fly through this. Basically, it means that if you're using similar indicators that have the same inputs and they're basically spitting out similar data, what you're doing is redundant. And adding rules, there's something called degrees of freedom. And when you're adding rules, degrees of freedom in robots, well, that would be nice. That's great, But in trading, you need to have those as low as possible. It's basically moving parts. How many rule sets do you have in your trading, especially when it comes to mechanical trading? That's important. And if you have multiple rules based on similar indicators, adding more rules with similar indicators does not help you. It hurts you. It makes your performance worse, actually. So anyway, there's a lot more about that we could talk about. Anyway, when it comes to what people believe about the markets, most people believe that it's price. Price is the most important thing, right? It's what all other indicators are based on. So, and if you're moving away from pure price and you're creating all these other second order indicators, well, the further away you get, the less or the worse the performance, basically. And why not just use just the price bars themselves? Well, long story short, it's really volume that creates price. Okay, I'm not going to go into too much detail about this, but there's so many people that say that volume is basically useless. There's a lot of people that teach that. And let me just say this one thing. Many suggest that the pure price data supersedes all other indicators data, that pure price is the starting point. And basically, I hold that, and I'm sure that a lot of you order flow traders would agree with me because it's true, it's objectively true, volume is the starting point. Of course, it's the first order information we have access to. It's the changing hands of futures contracts, whatever stock shares or options that creates the price. The fact is, it's the volume, the changing hands of the contracts that drives price. And if we don't fully understand that, then we're missing really the most important piece of the puzzle. Okay? And to truly understand how markets operate and why they turn, where and when they do, we need to understand price action, but in the context of proper volume analysis. So volume on a daily chart, it's really not that convoluted. It's a little bit tricky, but you don't have the same problems that you have with intraday trading. So here, even just a really simple little glossary overview of just looking at volume spikes, you can see that they coincided with some important turning points here. And that's just a very simple look at volume. Let's just move right along here. So this is where the problem comes in. When we're looking at trying to make sense of volume data on an intraday chart, what do we have going on here? Well, we have just gibberish. It doesn't even make any sense. The problem is we've got this high variance between the overnight session and the day session. So right now I'm looking at the day session. Let me turn on this little tool here. Yeah. So this is the day session. This is one regular trading hour session. This is the second one. So this is day one. This is day two. You know, the 8-hour session, basically, 7.5 hour, whatever it is, 7 hours, 45 minutes. And this is the third. Okay, so very high volume in the morning, very high volume in the evening. Overnight, incredibly low volume, right? Very, very low volume compared to the day session volume. In the Euro session, it picks up a bit, right? You saw that here. But even then, once we get, you know, let's say we could do something about the variance, we still have this kind of seasonality effect within the sessions themselves. So you see how volume does this kind of cup deal here. You've got very high volume at the open, very high volume at the close, and you have this kind of lunchtime lull here. And that's pretty similar over most days. But then you've got this. What's happening here? You've got this huge amount of volume sticking up here out of the ordinary. Well, what's going on there? That's excessively high volume for that time period. So we kind of need to look at those individual time periods by themselves if we're going to make sense out of the volume. Okay? The only way that we can do that is if we take each bar, each time period, and we compare that volume to the average volume for that same time period, for that same bar. Okay, and that equation, that basically relative volume, is what enables us to make sense of data that we could otherwise not make any sense of. Especially, you know, when it comes to like a 1-minute chart or a 2-minute chart maybe. After the market has opened, you get that huge amount of volume that comes in, then you can start to kind of manage it after you get through that initial period, but you still run into the seasonality problem within the lunch session. But with the relative volume, we're actually able to compare each bar's volume with the average volume for that time period over the past couple of weeks. And we remove the variance between the sessions, and we remove the seasonality within the sessions. You see? So now this bar right here is exceptionally high volume for that time period. You'll see what happens here in a minute. Now we're going to add range to the chart. All right, so we need to think about volume in terms of range, how the volume affects the price action. All right, what I want to do now is basically combine the range with the relative volume. All right, range is basically the high minus the low. It tells us, you know, how many ticks, how many the tick size is the minimum distance price can move in one transaction. So it tells us the tick size of the bar, and the average range tells us the volatility Okay, so in this session here, you can see it was very, very high volatility as the market was tanking, going straight down into that very high volume, wide-ranging bar kind of selling climax there. So we're going to combine the range with the relative volume and put these conditions together. I'm not going to go into all the different conditions because there are way too many to go into. But here we've identified a selling climax right here, very high relative volume, wide-ranging bar, and a buying climax, very high relative volume, wide-ranging bar. And I want to kind of go into those a little bit. So 4:05, I think I need to wrap this up, don't I? Let me try to get through a few more slides and then we'll continue this on Saturday. I've got a lot to go into. I want to make sure you guys understand the concepts, and then we'll go into a lot of different charts, a lot of different examples. Let me do this. Let me get through a couple of these. It's pretty self-explanatory, really. I mean, you've got a big down bar, you've got fairly low volume, and then all of a sudden you get a huge amount of volume on a wide-ranging bar. That's your selling climax. You've got the same thing in reverse here, big wide-ranging bar closing up on its high with a huge amount of volume. That's your buying climax. All right, let's see these. Well, that didn't work very well, did it? You give me 15 more minutes? Okay, perfect, thank you. Yeah, well, these are supposed to be videos here, but they don't work. And I'll know you, I guess. Anyway, this was just going to be a selling climax and a buying climax in action, just so you can see kind of how it builds in real time, but that's not entirely necessary anyway. All right, so here we're going to come back. We're going to look at range again, but this time what we're going to do is we're going to divide the volume by the range of the bar. What does that give us? That gives us volume per range. Now, there's a lot of guys that have written on volume analysis. I actually have a little video where I run through the entire history of volume analysis. I probably know volume analysis better than most anyone, really. I've been basically dedicated the better part of the past 10 years to this. It started with Wyckoff, basically. It started before that, but Wyckoff was the first one to really write a lot about volume analysis in terms of price patterns, okay? You've had a couple of guys come along and kind of create volume per range, just divide the volume by the range of the bar and then name it something else, like market facilitation index or something like that. Volume per range is basically telling us, that's out of place here. Volume per range it's essentially, we call it the density, but it's more like, let me just put it like this. When you're driving uphill, you use more gas, right? Hang on a second. Okay, sorry. I kind of think of volume as the fuel behind the market, right? And if you're driving uphill, you use more gas, right? And if you're driving downhill, you use less gas. Well, essentially high volume per range, we can make some generalizations about it on a daily chart and a weekly chart, but we can't really do that on intraday charts because of the same problems, the variance, the seasonality effect. But typically, on a daily chart, high volume per range would mean that price moved with a high level of difficulty. It had some restraint in there. It was an uphill drive, if you will. Very low volume per range would mean that price moved within that bar relatively unrestrained with greater ease. Okay, just to go through a couple of examples here. This is volume per range on the bottom. This is a daily chart. Volume in blue, range in orange or whatever that is, and vol per range in purple on the bottom. So we're going to look at a couple of very high volume per range bars here. And you see, what are they coinciding with there? They're usually narrower ranging bars, but not always. Not always. they tend to coincide with turning points in the market, or at least cause some sideways movement thereafter. And this is pretty basic stuff, but I think a lot of people overlook this sort of thing. So high volume per range, typically associated with demand coming in at a low, supply coming in at a high. Low volume per range, price moves with more ease. It's less restrained. So very low volume per range, the market moved very quickly and easily. Didn't take a whole lot of volume to move that market that distance. You see what we have here, this is the beginning of that new uptrend. This is really the beginning of that new uptrend here, actually. Here's another turn back up. I guess I'm blocking this one here. And that's where it turned back up from going sideways for a little while. So very low density tends to coincide with kind of a resumption of the trend, and basically tells you that there's not a whole lot of resistance in the direction that it's moving. There's another one. All right, so here what we want to do with intraday charts is we want to eliminate that same problem that we dealt with earlier with the relative volume, with the volume. And our solution was the relative volume. Now we're looking at the variance between the sessions and the seasonality within the sessions for range and volume per range. And we need to deal with that. We need to eliminate those two problems. And we do that with relative range, and all of these are different inputs for the same indicator. Okay, we've got the same indicator with different inputs that you can select, but I'll show you how we combine all of them into one here in a second for some pretty amazing signals, for lack of a better term. But here we have relative range. You see how it eliminates that variance between the sessions and the seasonality within the sessions. And then what we're calling density is volume per range. It's basically, how dense is the bar with volume. The relative density eliminates that variance and seasonality. Relative range, yep, relative density. So now we're looking at relative volume, relative density, and then just kind of comparing it to the volume per range. And here, what I've done now is turn on the high density and extreme density bars here. Right? These are going to be what make up the next signal that we're going to talk about. The next signal that we're going to talk about is what all of us have referred to for years as churn. Churn means, for those of you that may not necessarily speak English as a first language, churn means that the market is moving back and forth in a typically narrower ranging bar, usually than the previous bar at least. Basically, it means at a low, you've got clear demand coming in. And at a high, you've got clear supply coming in. Right? So that high density is one of the conditions, one of many, that make up the way that we do these churn bars, which is pretty unique. So here you can see I have the churn turned on. I put density on top now, relative volume here. So I've got the churn bars turned on. We've got one here. We've got one here. We've got one there. One here. That one there. And we got another one right here. So out of, what is that, 6 signals, 5 of them coincided with major swings. This one just kind of knocked the market sideways for 2 or 3 bars. Okay, and now you compare it to the volume below it. I marked this white line here so that you wouldn't think that that churn bar was that big volume spike there. That big volume spike there was that big selling climax there before the churn. So even with the volume per range on here, you can't there's no way that you can get these signals from the raw volume data. Right? That's why what we've done is so essential to making sense of the volume and to actually, making the data, formatting the data in such a way that you can actually use it now properly to help you find where the markets are going to turn, and it will signal to you these turns before the turn happens. Right? Volume is what's really the only true leading indicator. You could say that price patterns are leading indicators, but price patterns are another animal altogether. We're going to look at these two little sections right here. A lot of people see patterns in all sorts of things. I mean, we're humans. That's what we do. We find patterns in everything, and sometimes the patterns that we think we found are not what we think they are. So here we're looking at just the example of churn, but up close. So it's typically a narrow ranging bar. It's narrower than the previous, and very high density, but not necessarily very high volume. I'm not going to go into all the details of all these different signals, but what I want to show you now is how we start to combine this stuff. Okay, we're going to combine those two signals, the climax and the churn, together for another signal that's incredibly powerful that we can do specific alerts for. We can add into strategies. We can do a lot of different stuff with this, but we have text alerts, email alerts, all sorts of different things you can do. So here we have what we're calling a 2-bar pattern. It's basically, it's like a cycle of the volume. You've got the selling climax that immediately hits support. Support is demand, and resistance is supply. So for a selling climax that immediately hits demand, that follows through onto the next bar, you've got that climax followed by a churn bar. For the buying climax that immediately hits supply, you've got that big buying climax followed by the churn bar. So that's that 2-bar pattern. Well, it's basically a completed climax. Okay, but here's a little trick here now. You've got, this can show up in a couple of different ways. It doesn't necessarily have to transpire over 2 bars. Okay, Jared, just tell me when you want me to wrap it up, and I'll go ahead and answer some questions, and then we can do the rest of this on Saturday. So just tell me when you're, when we got to wrap it up. I'll try to get through this one and a volume divergence, and then we'll see if we can do that. Yeah, okay. All right, so what we've got here now, we're looking at density in the bottom. Both of these are relative. Now we've eliminated those problems with the data. So we've got volume on top, density on the bottom, and you'll notice that some of these climaxes also have very high density. And what we do is we combine all of these together. We combine the relative range, the density, the volume, all into the same plot so that we can see both of them at the same time, and we can determine which ones we want to turn on and off, which ones we want to accentuate, and we want to accentuate those climaxes that also have very high density. Because what does that mean? Think about it. If a 2-bar pattern, you've got a selling climax followed by a churn bar, indicates a sort of a completed climax where you've got selling that's then met with buying, stopping that move that's going down and then taking it back in the opposite direction. If all of that happens within the same bar, what would you expect to see? A high density climax, right? That's what you've got here. At this point, I'm losing some of you guys undoubtedly, but this is kind of what it's all about here. It just takes a little while to get the hang of this because it's something that most people aren't really typically interested in or even think about, but understanding the way that volume affects price is probably the most important thing you could major on when it comes to trading. We have another one here, big selling climax, very high density. And then what? This is interesting here. So what happens? Doesn't quite stop there. We've got the demand that comes in there, the support. It drifts up a little bit, but then it comes back down a little lower, ending with a churn bar. What's going on there? Well, that is actually, this is my bread and butter deal right here. This is volume divergence. It may be a little bit difficult to understand, but let me just try to explain it as quickly as I can, and we'll see how it goes. If you guys have any questions, just let me know if you do. So it's kind of basically what we're looking for initially. We're looking for a big, in this case, a selling climax. We have a bullish volume divergence here. We're looking for a big selling climax, typically after some high momentum. Okay, when the market's moving straight down like that, you typically aren't trying to buy it right there. You want to see the momentum start to wane. You want to see a sign of strength and then come back down and test that prior low before you start thinking about getting into that. Right? You don't want to try to buy it right there as it's going straight down on a 15-minute chart. So we're looking for that big selling climax on high momentum. Then we're looking for it to go sideways, give us a little bit of a sign of strength, come back down and test that low, and hopefully not go too much further down, because then it would become invalid. But test that low, break it maybe a little bit, and do so on decreasing volume. Okay, that tells us that the sellers now have dried up. You had a ton of sellers in here. They were met with some demand, obviously, because the volume is so high. All right, but now, after you've moved up a little bit, you see that the market has the potential to start moving up. Then it comes back down and it tests that low, and it does so on less volume. So you've got less sellers in there now. So it's kind of, if you're going into a low, this is kind of the confirmation that the sellers have started to dry up. And then when you get a churn bar coinciding with that, well, that's just the icing on the cake right there. So that's a beautiful volume divergence signal at a low. This is a really nice one at a high. This is after a 2-bar pattern here, and then a sign of weakness, and then just completely sideways momentum. So huge momentum divergence there as well. And then it ends on a big churn bar right there, and then it goes straight down. So this is just a really nice example here. Yep, and there's everything that I just told you. So this is just up close here. The little circles mark the setup bars. So the signal occurs right there. That's the setup. And then the trigger occurs once you move out of that. So you can turn the setups on and see all of these in real time. It doesn't back paint. It's not some type of deceptive garbage that I've seen other vendors sell. There's nothing deceptive about this. It's made for identifying this pattern and doing it properly. And this is maybe one pattern that some of you don't even know about, because I don't think it gets, well, I don't think very many people know about it, but this is one of the most important confirmation patterns that we use, okay? I'm going to have to wrap this up here, guys. I'm going to get into the bar type and all of that on Saturday, but let me just show you one little thing real quick. Yeah, sorry. Okay, so this is an hourly chart of gold. This is a volume divergence that we just had in gold. You see the big high momentum move that ended on a climax, sign of weakness, and then went back up on decreasing volume. Okay, I'm just going to show, actually no, let's go ahead and stop, because I'm taking up way too much of your time. We'll go into putting all this into practice with some examples. This is just, I try to show some charts from today. This is crude oil today and yesterday on a 10-minute chart. Remember that 2-bar pattern we were talking about? It's kind of like a completed climax. Big buying climax followed by a churn bar. That marked that high yesterday. Big selling climax followed by a huge, huge churn bar. Well, that marked that low. We got a little volume divergence here. That was the overnight high. And then we have really high momentum, high density climax followed by another churn bar marking that high. So I can show you example after example after example of this all day, every day. This is the new bar type that I'll be going over on Saturday. And I'm just showing just something, simple that you guys can understand, just mean reversion type stuff and trend continuation. So we'll go over all of this in depth. I'll show you a lot of examples. And one other thing, I'm going to have this for you guys as well. This is a profile per bar indicator that we're going to give to you as well. It doesn't, well, we'll get into all that. It basically looks for the point of control and the value area or the volume cluster of each individual bar. It's not tied to the VolumeAnalyst yet, but it's something we're trying to add. We just need to redesign it to get it to work with the VolumeAnalyst. So it's going to be a little while, but we have a lot of different ways that we're making this even better. That's kind of what I do every day, is try to make stuff better. And we've actually added in a little back testing tool to the volume, which you can check down here to turn on back test, basically to test what happened within the next 10 bars or 5 bars or 10 bars or whatever, and it will spit out the results into an Excel spreadsheet. So that's something that's available in this update as well. All right, yeah, let's take some questions and call it a day here. Goodness gracious, we've got a lot of questions, don't we? Josh, are there any right off the bat that you've seen or kept track of that I could answer? Thanks, Craig. Does this, yeah, if you have the VolumeAnalyst for Ninja 7, yeah, this is a free upgrade. But if you want to, you can send me a check for $5,000 or $6,000 and I'll go ahead and cash that. Or you can send me a check for $100.
Scott had asked about showing a GPD USD pair, so maybe that's something that we can make a note of and cover that on Saturday and just show that example.
Pound, what one? USD? Okay.
Yeah, USD.
Okay.
Yeah,
cool.
I'll make a note of it.
Yeah, we'll go over how it works with a 4X. Obviously, with 4X, we don't have the pure volume data, but we have total number of transactions, which a lot of people have done studies on that. It's something like 93% correlated, or 0.93. Yeah, so it's not perfect, but we can still get what would be normal standard volume signals from the real volume, which you would see on the futures contracts of the 4X futures. So that it's comparable. I'll show you that on Saturday. Yeah, Saturday will be recorded. Let me grab the link. And it'll be at 4 p.m. We'll go into more details about all the ins and outs of the software. Basically, we'll go through all these different inputs, volume per second, relative range, and range. You haven't seen a tenth of it yet. It's a lot to get through, and I wanted to give you guys some background and kind of help you guys start thinking in terms of we'll just try to get statistically minded, because that's probably the most important thing that many of us overlook when we're getting started. And sometimes it It takes those blown accounts to stimulate us into doing things properly. And yet we still make mistakes. I still make mistakes. But anyway, and the real-time bars has the same colors. No, it happens all in real time. There's no back painting. It's, no. Yeah, everything is in real time. Nothing changes. This is that new bar type. The new bar type, I haven't had time to get into it, but it's a blend of range, tick, and seconds. So I'll go over all the details. I know a lot of you guys are interested in that, I'm sure, because we talked about it so much, but I don't know. It always takes me a while to go through the information. And there's really just so much of it to cover, but I'll go into the bar type and that profile per bar, and we'll go through a lot of different examples. But yeah, the signals are real-time signals. They occur while the bar is forming, and you know, they don't wait for the close. All of this is real-time, tick by tick. You might think that that's somehow a performance drain, but it's not at all. We run massive workspaces with tons of charts, and especially now in Ninja 8, that's not an issue, even remotely. It'll be at 4 on Saturday, and I need to. Do you have that link, Josh or Clint or somebody? I put it in earlier from a slide. Let me go back and get it here. Yeah, sorry guys, I'm not.
Yeah, I've got it here. I'll post it.
Huh? You got it? Yeah,
Yeah, I
there's
just
the link.
posted it. Mm-hmm.
Okay, good. Yeah, I don't even have a proper closing slide. Anyway, we'll go through all the details. I'm not actually putting it up tonight. I'm going to wait until we can actually go through all of the details, and we'll kind of close it out then. So we'll do the full demonstration, go over a ton of examples, all the features and all of that, and then we'll excuse me, we'll wrap it up and close, and then we'll make it available with a ridiculous discount and tons of free stuff. So it's a pretty nice deal. And then next week we'll be having a lot of live training on this, at least 3 days in the afternoon, which will go probably an hour and a half to 2 hours each time on just the volume analyst for Ninja 8. So we'll be doing a lot of live training over the coming weeks for this, at least over the next 2 weeks. Okay, so I'm sure there are hundreds of questions. Guys, I'm going to have to let, it's already been an hour and 15 minutes. I'm going to have to have Jared come back on and wrap this up. If you had a question that I couldn't get to, there's a ton of text in here. Maybe, Jared, you could send me the transcript. If you guys would write in to support at TradeThePlan.com, then I'll be sure and answer those between today and tomorrow, whenever you send them in. And otherwise, we're going to do a full Q&A on Saturday for as long as you guys want to do it. So we'll stick around for a while, as long as you want, and we'll go through tons of different examples. So we'll go over, you know, the pricing and all that stuff on Saturday. Okay.
All right. You okay if I jump in here now, Daniel?
Sure. Yeah, please.
Yeah. So just want to give a special thank you to Daniel Rowe and Josh from Trade the Plan for their great presentation today. Just a heads up, NinjaTrader ecosystem is pleased to sponsor these weekly events as a value-added service for our clients. If you find value in these events, we hope to attend them on a regular basis. Just want to remind everyone that the information provided in this was that of Trade the Plan and not NinjaTraders. All the information was for educational purposes, should not be construed as trading advice. So again, we appreciate the time you spent with us today. Please enjoy the rest of your day. We hope to see you again in future webinars. Happy trading from all of us here at NinjaTrader.